welcome to our table talk. I believe we're allowed to talk now. All of you should be excited. You have 3 lawyers on a call. Try not to fall asleep, but we're hoping this will be exciting for you, and we hope this next half hour will be value packed. And value is going to be our theme today. So I'm Vanessa, I'm a corporate lawyer, and I'm going to talk about one part of value. My colleague Lorelei, though, is going to start us off in a minute. I'll let everybody introduce themselves. She's going to talk about capturing value in the ag space. I'm going to talk about how to unlock value, how to raise money to continue to unlock value. And my terrific colleague, Darren, who is a tax lawyer, is going to talk about how to continue to retain value. So without further ado, so again, Vanessa Grant, I'm a corporate lawyer. I do money, mergers, and licensing. So I help clients raise funds. I help clients enter into a relationship contracting. And finally, I help clients sell their businesses after they've grown them. Doing this for about 25 years, and I have a 100-acre farm. So I feel a little bit of your pain. Over to my colleague, Darren, to introduce himself, and welcome.
Hi, good afternoon. Thank you, Vanessa. As Vanessa said, Darren Hippolyzer. I'm in the Calgary office for my career, and grew up in central Alberta on a farm. So, all of this is pretty close to home as well. I get to see tax from kind of throughout the value chain process. So everything, starts out with Lorelei, as we raise capital and as we exit or transition with the help of Vanessa. So I get to see a little touch on all of that. And over to you, Lorelei.
Thanks, Darren. My name's Lorelei Graham. I'm an intellectual property lawyer at the firm, practicing predominantly in agritech, working on every aspect of that, including brands and patents, industrial designs, and commercial intellectual property. So helping Vanessa monetize that IP that we're developing. So without further ado, we're going to talk about as Vanessa so aptly put, creating value. And so no matter sort of what part of the agribusiness chain your business operates in, creating value and building brand in your business really involves knowing what your value proposition is all about. And that current value may be in tangible assets, so things like inventory or real estate, or it might sit in intangible assets, things like proprietary knowledge, a trade secret, or innovation, or it could be a combination of both. We're typically seeing more and more agricultural related businesses focusing on intangible assets to provide them with exclusivity in their activities, which adds value to their brand and their bottom line. But regardless of the mix, these assets really form the foundation of your business and the value in your business. So given the breadth of the agricultural industry and its key importance in today's world, your business may be pivoting or changing from these sort of traditional foundational assets to meet the changing demands in the ag industry that we're seeing today. And with any business, transformation is critical that you understand your value proposition for your business, and that when you do that, it maps into your business plan, and that you're checking in at regular intervals to ensure that you are on track with your goals and sort of maintaining that path that you've set, as well as continuing to build value into your business. So this means that you want to ensure that you're solving the right problems at the right time, and so that you have an effective business transformation, and that you're protecting your brand as it currently exists, but also as well as adding value to the business where possible and limiting risk to the business wherever you can. So solving the right problems and transforming your business at the right time means that you have to assess your offering relative to your business plan. I typically recommend taking stock of what you currently have, almost like an audit, so that you have a starting point, and then ask yourself, what do you need to solve the problem or affect that business transformation? You may already have the right assets to achieve that transformation, or you may determine that you need to acquire them. And finally, you should scope out what do you want to have. It may be that to achieve that level of success with your business transformation that you're anticipating, that you will need to prioritize those wants. This type of audit sort of ensures that your business is protecting and building on the right assets at the right time for a successful transformation. It's easy to focus on what you want, but it is important to first understand what you have and what you need to transform your business successfully before you get to your wish list of wants. So for example, it may be that you want to transform your business by digitizing certain aspects of it. Understanding your current assets and your in-house abilities will help kind of you decide whether you can effectively do this in-house or whether it makes more sense to work with a third party. It may be that developing and executing internally allows you to develop a custom platform that gives you not only improved efficiencies, but a completely new revenue stream. Having that result and the exclusivity it brings not only solves the problem, but it also allows you to have faster and more successful commercialization and business transformation. So when responding to like the ever-changing pressures, it seems in agriculture, certainly the current one that we're seeing with climate change, it may mean that you identify multiple problems that you need or want to solve, and therefore you're going to experience multiple transformations or pivots in your business. The result is that you may end up diversifying beyond those foundational intangible or tangible assets that you identified in your audit. This diversification or pivoting to new value propositions, I know at times may seem challenging. However, it may be necessary so that you remain competitive. More importantly, the right kind of diversification can and will add value to your brand. So we're big proponents of an informed commercialization plan for your assets that is in step with your business plan and that helps you take advantage of the relevant opportunities that really make it essential for your success. So commercialization and financing your value propositions is the next step on the journey. So I'm now going to pass the baton over to Vanessa.
Thanks so much, Lorelei. So Lorelei, that's a great description of how we're going to start to capture and think about value. I'm here to help unlock that value, lots of ways to do that. And just as a note, I've put a little note in the chat. Please feel free to answer questions. We are always open to questions, no matter how you feel about them. A good question, everybody is probably thinking about it too. I'm going to start though a little bit. Lorelei has touched on it. You would like, as you're transforming your business, a really strong commercialization plan, but we've got to layer that commercialization plan on top of or underneath, I don't care where you put it, with your financing plan. How are we going to finance this transformation? And even before I get there, I'm going to talk about really three things. I'm going to talk about financing, I'm going to talk about succession planning, and I'm going to talk about what's the exit. I want to talk about the exit. So does your succession plan mean that you are going to create the great Canadian business that is going to be handed down through generations, and that is perfectly fine? Are you going to create a business that you can spin off and sell to someone else and, possibly use that money to create more businesses? Who can say? But the question that we always ask ourselves when we're talking about unlocking value is, after you've got that commercialization plan, you've got that great idea, you're transforming your business, what do you want to do with it? What's the end game? Because the end game will dictate everything that comes before. So it'll help dictate your tax planning. It'll help dictate what additional value you're going to add. So the first thing I always ask is, hey, are you creating the great Canadian business to hand down to your children? That is fantastic if you are, but that's going to lead you down a different financing path and a different tax planning path. Conversely, if this is a business that you think, you know what, it's a great business, I'm going to work at it for like 10 to 15 years, and then I'm probably not the right person to take it to the next level, and that's perfectly fine. I'm going to find someone to buy it, someone to take it over, whatever the answer is, then that's a different tax plan and a different financing plan. So the first question, after you've got that commercialization plan, that great idea, is what am I going to do with it at the end? Now, also understand that lots of people go, well, Vanessa, how the heck do I know that? Great question. I don't know either. but you got to start somewhere. You have to start with a plan in mind, but you need a plan that will be flexible enough to enable you to pivot as things change. Now, let's just assume we've got that. We have an idea about what we're going to do with the business. We're going to grow the Great Canadian Business, or this is a build to exit business, as we call it. Then the question is, how are you going to fund it? 4 main ways, probably lots more, but I don't have enough time to go through all of that. But there are essentially 4 main ways. One, you can do it yourself, bootstrapping. Thank you, Bank of Visa. Thank you, Bank of Mom and Dad. Thank you, Bank of all my friends and family who love me. That's one option. Option 2 is not the Bank of Mom and Dad, but maybe the Royal Bank of Canada. Each bank has its own lending requirements. We'll talk about each in turn in a minute. Third is maybe government funding. Are there grants available for what you're doing? Are there government sponsored loans, like through Bank of Business Development Bank of Canada, for example? And the final, which is the area where I particularly specialize in, is of course venture capital funding. Each of these 4 main ways of fundraising, again, there may be more, and lots of you will have other comments to make, I'm sure, on your own individual transformative journeys, but each of them has their own challenges. Self-funding obviously is tough because you've got your limits, you've got your credit card limits, you've got maybe families you have to look after. So those are serious considerations, and you've got limits to growth. So depending on what your commercialization plan looks like and what your business development looks like, that may be the right answer for you. You may be able to self-fund to kind of grow and transform, and then the business will generate its own cash flow from there. Perfectly fine. Banks are another conversation. Banks usually need some form of collateral. So you may be looking at, securing the loans with personal guarantees, or securing loans with your house, those sorts of things. Again, none of this is good or bad. It just depends on the context in which your business is developing and transforming. Government grants are always something I tell clients to take a look at. Lots of government funding, whether it's in the form of refundable tax credits, whether it's in the form of Crown Corporation type loans, as I mentioned, like Business Development Bank of Canada, or federal government or Ontario government loans, lots of loans and grants available to you on terms that are not the same as the standard commercial banks. Finally, of course, there's venture capital funding, a whole other journey in itself. I will not do it justice in the 5 or 8 minutes I have for my part of the conversation. I will say, however, typical venture capital funding plans look like this. And when I say typical, you should always think in your mind, aha, there's an exception to everything this woman is saying. So it's not fixed in stone. But the general trajectory is you'll start with small investors, usually angel investors, people who've done really well and who want to give back to the community, but also who feel that they can give back in more meaningful ways, such as providing guidance and advice. They will make investments. They will buy shares in your company. You will own less and less of your company over time, but that's okay if the value you're adding is exponentially growing. Sorry, I wasn't allowed PowerPoint, so you're getting hand graphs. Not great, but there you go. So then, after you've got your angel investors have a limited amount of time, limited amount of money. You'll need likely bigger funding, and that's where venture capital funds come in. They will typically do more than one, what we call round of financing. Sorry, I'm glitching, so you're getting weird facial gestures frozen, always fun. They will do rounds of financing. They will buy shares which have greater and greater preferences when the company is sold, which means their last money in is going to be the first money out when the company is sold or has an exit event. Again, over time, you lose control. What you gain for that is hopefully enhanced value, which is exponentially greater than the loss of control that you have. But remember, a venture capital journey is a journey of control, value, and dilution. Lastly, I just wanted to talk briefly again. We said we'd start at the end for what kind of company you are. If you are a company for the ages, and if you have a great idea, you may think about monetizing or realizing value through relationship contracting. So you might license out some of your idea, you might be providing services with your idea, and that's another way for you to continue to unlock and enhance value. So to summarize really briefly, Lorelei set the stage beautifully by what is your value proposition. Your commercialization plan and your value proposition will dictate two things: whether you are build for the generations or build to exit company. Neither's good, neither's bad. They just are what they are. And in turn, those two types of companies will dictate how you finance that commercialization plan, whether it's self-financing bank loans, government grants, or a journey with venture capital, or a combination of both. And that leads me to my terrific colleague, Darren, who's going to help you think about how you're going to retain that value over time. Darren, over to you for the tax conversation.
Thank you, Vanessa. Don't forget, in the first stages, one thing we don't talk a lot about is SR&ED. So you usually wouldn't think about it necessarily, but scientific research and experimental development can be very useful. It's things like, process, technological advancements, not just sort of pure science, but that process changes or improvements all can fit within that. So, as we're using our scarce resource of this capital that Vanessa's helped raise, SR&ED can be a pretty useful tool in that. So don't forget that when you're spending money on what you're doing, and have a good review of what that money goes to. Then sort of think about tax. The next big characterizations are distributions. So what do you do with profits along the way? How do you manage those? And then finally, when, back to Vanessa's comments about the off-ramp, where are we going on an exit? What does that look like from a tax perspective? And, agriculture is interesting because we have the universe of all of the regular tax rules, but then we also have a lot of very specific agriculture-based, farm property-based, capital gains exemption property-based that aren't available to kind of your average machine shop down the road. So some interesting planning that we can do for ag-related businesses that aren't necessarily there in other contexts. So just about distributions. Two obvious ways to get sort of cash flow out of the way, along the path of the business before we hit an exit. Think about dividends, think about interest to the extent, depending on where we got the money from, internal, external, bank financing, what's the treatment of that interest to us of the business, and can we carry that cash flow? Dividends to investors, again, to the extent that we're getting private equity backed investors, they will often have a priority to dividend entitlements. So whether that's a cash paid or it just accumulates, that goes to the amount that you're going to have to pay out to them in advance before it gets down the path to you. Then you get to the, where the real money in tax savings can lie is at the exit. So whether that's capital gains exemption on an individual basis, which, if you can put, upwards of almost 900,000 in each individual's pockets without paying tax, that's a nice reward. So in addition to, a qualified small business corporation, which is any business, active business in Canada, that rule can apply for certain qualified farm property. So if you own farm property within your business that you use or your family has used, you can use it for that as well. And then so some of those same farm property rules work very well on a transition to multi-generation. So let's say you're moving your business down to your children and your grandchildren. You can use pass-through, estate freezes or other transactions where you can realize capital gains exemption through multiple generations. Gives you an ability to move that value down the generations without having to cut the check to Her Majesty along the way. And you can mix and match a lot of those. So your PE backer can get their entitlement, and if structured right, depending on where control goes, you can often have advantages from both of those. You can raise the capital from the funds that Vanessa refers to build the value that Lorelei referred to. But depending if you can keep control in Canada, some of those same very advantageous tax rules are still available to the founders as you either exit or transition the business to the next generations. So I'm watching the chat here on the side, and there has not been what I would describe as a flood of questions yet. So please encourage people to share if they do have some. But maybe I'll circle back and let either Vanessa or Lorelei offer anything that they've had sort of as we've had the benefit now of hearing each other speak kind of live.
Thanks so much. Lorelei, I don't know if you wanted to add anything.
No, you go ahead, Vanessa. No, go ahead.
Well, I was just about to say, well, either 3 lawyers have put people to sleep successfully, mission accomplished, or people are too shy, never be too shy, or we haven't quite described what would be helpful to folks. So please let us know if there's anything that we can do to add value to your day. Our job is as lawyers is to add value. In terms of transforming your business, remember there are sort of 2 conversations here. Lorelei specializes in ensuring that we capture value through exclusivity. Now, exclusivity can be characterized one of a number of ways, but you usually think, thank you, Alexis, I owe you, I'll answer your question in a minute. But you think of exclusivity as, do I have a trade secret? Do I have anything confidential? Do I have a patent? Do I have a trademark? Whatever that is. But there's also what we call first mover advantage. So think about your Uber and your Lyft. It's not like a cab hasn't been heard of before, but somebody reimagined that cab for an Uber. And that's really a first mover advantage. They just had a way of rethinking how I can get my cab and how I can pay for my cab. But ultimately, it's still a cab. They just had a really, really good marketing and branding approach, again, over to Lorelei. When should people come to see us? Oh, please God, come early, because it costs a ton of dough to fix anything that you thought you could do yourself. But I'm just going to let that drop, and maybe Lorelei wants to add to that, because first mover advantage matters.
Yeah, you could see me chomping at the bit there. I think I would just add that it's important in agriculture, especially. People think of it sometimes in agribusiness, because I think it's such a large industry that percolates through lots of different things that we do every day, from what we put on the table at the end of the day, but even all the processes in food industry that get us there, or the beverages we drink, et cetera. And so I think, to Vanessa's point, it's and your Uber example is awesome, Vanessa. It's about reimagining the value in your business. So what you might have traditionally have looked at your business with these, what I called foundational assets, as you see life changing around you, and certainly the last couple of years we've seen a lot of change. It's thinking about how you can reimagine some of your assets, or how you can change them or diversify into an area that makes you more competitive, gives you a different revenue stream. And that's something that, to be quite candid with you, we see now almost on a daily occurrence in the ag space, in intellectual property. And it doesn't always mean that we're filing patents. And I didn't want to get into a technical discussion on IP, given the brief amount of time we have together today. But I do think it's something that we need to think about, and you should think about a bit more, only because it can really add value to that bottom line. And as Vanessa takes you through, it's what financing and certainly venture capital folks are looking for. They're looking for that exclusivity, what makes you special, and cuts out some of the other folks out there. So there's some more questions here, and I think they look way more like, I hate to say it, text questions. So I'm going to be quiet.
Well, one from April, though, is what's the most common intangible assets you've seen in the agriculture field? Holy Hannah, that is like the world's broadest question. So,
but with a flavor on carbon, right? So that's exactly it. April, sorry, April, I was focusing on the next question. That's exactly it. Energy transition, and as it relates to the ag space, is monumental. It's what COP was all about. That you will have seen in the news. So all kinds, mostly, to be quite candid with you, ways of changing the business to meet those requirements, or ESG requirements that businesses have committed to. So it could be everything from changing processes that are more carbon neutral, all kinds of different stuff. So that's where, are we going to acquire that? Are we going to go outside and maybe buy a company or work with somebody to acquire that, or are we going to do it in-house? And it could be something as simple as, software that changes things up. You never know, but sometimes there might be some innovation there. And then if you can protect that and make that as your own, not only could you do it internally for yourself, but potentially use it as a licensing, another revenue stream through licensing that Vanessa mentioned. So quick question there, because I know we have a time limit. So quickly,
Right.
tax.
So yeah, succession. So there is an ability to, whether it's next generation or third generation, or even outside of the family. One of the most likely used is a freeze, where the existing generation takes the value of what it is today, they capture that, and if that's, $1 million or $100, or fill in your number, existing generation keeps that, new generation, management or who else is going to carry on the business goes forward, subscribes for the new shares and gets the growth from there. There's some additional benefits if it's within the family, but you can certainly do it if it's outside of the family as well. Would be the easiest way to manage that. Easy in the.
Yeah, someone said in succession farms, one Jason, what is your best advice? I'm going to add a little bit to Darren's point, which is the lawyer's really annoying answer. So I'm going to apologize, but it honestly depends. It will depend on your particular circumstances. And most importantly, and I don't want anybody to lose track of it, what is important for you? And that is candidly the only thing that matters. I can give you best advice, but if it doesn't resonate with you or doesn't meet your goals, it doesn't really matter. So the first question that everyone has to ask, and I started with it, is what's the game plan? What's the game plan that you think is going to make you happy? And then you ask the question, okay, thank you, tax and corporate and other advisors, that's a great game plan for what I've told you. Is this a game plan that gives us some flexibility in case I need to pivot in the future? And the answer may be no, it gives you no ability, and that's perfectly fine. At least you know that up front. So the best advice I've ever given anybody is ask yourself what's important to you and make sure that your plan reflects it and gives you some ability to pivot. And thank you.